Hello there, welcome to Market Call. Kim Bolton is on our show today, President and Portfolio Manager at Black Swan Dexteritas. Great to see you, Kim.
Well said.
He will take your calls, emails and tweets on technology stocks. Call him toll free, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Before we get into your broad thoughts about tech, you have some concerns about the market as a whole. You think that the downside is looming?
Well, you know, fundamentally, it's a green light.
Okay.
Technically, there's some warning signals out there. It's just it's overbought on a bunch of metrics. But then also you're going into this blackout period. So when you look at, you know, the fundamentals, the technicals, and then you got the capital flows, you have this blackout period.
Well, what do you mean, for earnings or no?
for the buybacks? Oh. So starting this week, going through next week, it's about 85% of the S&P 500 are not allowed to do any of their buybacks.
Because it's ahead of earnings?
Correct.
Okay.
And so, you know, that takes away, you know, some support, some demand in the marketplace. But look at today. We're off to the races again.
What are the technical indicators that jump out for you right now?
For a number of our stocks and our ETFs in that publicly traded technology space, we run a bunch of technical metrics, but especially when we look at the 50-day moving average, and we put 4 and 5% bands around that. This is the longest period that you've been above the first 5% band, and it's been going on for almost 2 months now, and it's quite an analogy out there.
We're into an era of big data, of course, in part because these tech companies merrily harvest data about us and try to use it to modify our behavior. How are you playing that big theme right now?
It is a massive theme, and it goes across a lot of strategic trends out there. All the way from the communications to the data processing with the 5G deployment that is going on out there. It's a huge, huge business. In 2019, when you look at the communications, the processing, and the 5G deployment, you're really looking at $3.8 trillion of spend this year. I noticed that you have the diagram up here. So when you go from 6 o'clock to 12 o'clock, that's the communications sector. And that communications sector is made up of telecommunications equipment company and IT communication companies. And they very much overlap. But then going from 12 o'clock down to 6 o'clock, you have the data processing side. Now it's interesting, the communications and the processing, they need each other. But then you bring in the 5G deployment, which is going to produce, because there's more data that can be actually sent around through IoT, through mobile devices and so on. So there's going to be more data out there. And then the processors, when you look at that diagram, that's made up of sort of the digital players and the FPGA, the field programmable. But now, you know, historically you've had Micron and Intel and Xilinx, who were the suppliers of those digital and field programmable chips. But now you have the likes of Apple, Google, Amazon, that are actually producing their own chips.
Yes.
And they're doing that because they have specific data processing needs. So it's all intermixed, but it's constantly changing. But it's a huge business, $3.8 trillion of spend.
It's fascinating how companies like Google moving into being hardware makers as well, or certainly needing to make hardware.
Exactly, but it's for their specific data processing needs.
Okay, we've got a lot of ground to cover. We're delighted to have Kim Bolton here today, President and Portfolio Manager at Black Swan Dexteritas. He's answering your questions on technology stocks, 1-855-326-6266. Here's an email from Mark in Unionville, Ontario. Nokia versus Ericsson in the 5G sector. Would you prefer Nokia over Ericsson?
That's difficult because we've taken profit on both of them. We had Ericsson initially, and then we built up to about a 6% position, and then we wanted to add, and so we actually added to Nokia. And so we're out of both, and we're actually looking for them to come back. If you look at Nokia, Nokia trades over in Helsinki, and it is currently around €512, price target of about 560. But we decided to take, they came out and they were their top and bottom line were actually missed on. They missed on both. Ericsson is interesting. Ericsson is currently, and it's trading just about 930, I think, down in the U.S. It's been all the way up to 970. We took profit right around this 930. We looked to buy back in with an 8 handle, 890 or something.
Right, but not intriguing you right now.
It's just expensive.
Yeah. And Nokia, do they even make phones anymore?
No, they don't. They sold all their phones to Microsoft.
Microsoft, of course.
Yeah.
And was that kind of ill-fated? Did that work out for Microsoft?
Not at all.
Didn't work for them.
No, not at all. Not at all.
And Ericsson make network gear. No, they don't make phones.
Yeah.
They don't.
And so they were very much, both Nokia and Ericsson were the beneficiary of that whole Huawei controversy. However, a lot of the European telecoms have actually backed away and not sort of followed the U.S. And so it's sort of brought Nokia and Ericsson back down to earth, because a lot of the telecoms and IT communication companies over in Europe are actually now buying from Huawei.
Oh, okay. Yeah. JB in Ottawa, go ahead, please.
Thank you for taking my call.
Pleasure.
My question is on Micron technology.
Okay.
I heard your speaker touching a little bit initially. Now, I realize this stock was 3 months ago much lower than it is now. It was tempting then, it is tempting even now. Now, the thing is only I was wondering if this price would be considered the entry point, and what would be the target? That's my question. Thank you.
Thank you very much.
Okay. We don't own Micron individually. We actually own it in the SOXX, in the ETF. We normally, in that SOXX, will hold around a 10% position. We've only got about a 2-3% position in there right now. And the reason we've actually scaled it back is because there's not clarity into the future about the memory chip market. And you had Micron that came out and warned, as you said, JB, as you said back in January, and then a couple of weeks ago you had Samsung that warned on it. So we're underweight, actually, when it comes to Micron.
Oh, okay. So not interested right now. Niraj has sent us an email, wants to know about Xilinx with its recent run-up. Is it still a good buy?
Yeah. Yes. We had about a 5% position in Xilinx. Xilinx is involved in field programmable array chips. And what it is it's a circuit that allows programmers to actually program the chip, rather than having the chip programmed when it comes out of the foundry. And so, and they've really got a very clear niche. They feed into the gaming industry. They feed into the AI and machine learning industry, and it has great opportunities in computing and network and storage. Our 12-month price target is at 122, and here it is sitting at 130. And that's why we're underweight, actually, in Xilinx. We'd look to actually, we started taking profit down at around 120. We have a smaller position right now, but I think you'll probably be able to pick it up cheaper down around 110.
And what's the advantage of pre-programming the chips like that?
It allows the developers out there that once the chip is within the hardware or the machine or whatever you have it in, that you can actually, instead of taking the chip out and buying a new chip and getting a new chip to put in, you can actually program it on the chip. And so, and it's very difficult for other people to actually play in this place. They have a great moat around this. But you can see where it could be useful when it comes to the gaming and when it comes to the AI and machine learning and deep learning out there.
We've got Andre, not Andrew, in Chilliwack, BC. Go ahead, Andre.
Oh, Andrew, thanks for taking my call.
Thank you very much.
Oh, you still remember me from yesterday?
Oh,
How
I sure
wonderful.
do. Thanks for calling.
All right, thank you. Andrew, the question, please, for the guest is NVIDIA. It is a semiconductor. It's highly cyclical, but it's come down to 150. Would you enter at this price? Thank you.
Thanks very much. NVIDIA.
Thank you very much for the call. We don't own it. We would buy it down with a 120 handle on it. Again, this is they cater very much to the gaming industry. Before it used to be over into, well, gaming and also into the autonomous driving ecosystem.
Vision.
Yeah. And, you know, it got all the way up to well, here we are up
300
at 1.
it looked like, yeah.
And so we believe that you can probably pick it up closer to that sort of 125 to 150. It's just a little bit stretched here.
Okay, Andre, thanks for that question. We're going to be back with Kim Bolton, President and Portfolio Manager at Black Swan Dexteritas. The topic today, technology stocks. Give them a call, 1-855-326-6266. Let's head to Burnaby, BC. Caroline is on the line. Go ahead, Caroline.
Yeah, I want to ask about OLED, Universal Display. I see it's up today at 4.8% in a 52-week high of 167.49. Is it a hold? Your comments, please.
Universal Display.
Thanks, Caroline. You must know that it's one of our favorites.
Okay.
We had actually in Universal Display, we got all the way up to about 7%. It is in our top 5 holdings, and it has been for quite a while. But we sort of trade around. I think you said it was around 167. Our price target on here is 175, so we're pretty darn close. We took a little bit of profit yesterday and the day before. So we're down to about a 5% position. Just for the other listeners, OLED, Universal Display, they have the royalty on the screens. So on the smartphone, whether it's a Samsung or whether it's a Huawei or a Apple, the new screens that are coming out come from the likes of Universal Display. And what they did is that normally in past years, that screen had about a dozen layers in it. And with this new technology that they have for their screens, they actually narrowed it down to about 3 or 4 layers. It gives better clarity, better pixels, but it also opens up room within the phone for power management and also for memory and so on. So most of the smartphone makers are going to the OLED screens at this stage. It was just announced yesterday, for example, 3 of the phones from Apple in 2020 will all be OLED screens.
And Universal Display will get royalties then? Or?
Correct.
Okay.
And what a beautiful business. It sounds like a Warren Buffett business, right? Where it doesn't matter which company, but they got it all covered, from Samsung to Huawei to Apple. It's a terrific story. It is volatile. If you remember back in December, when you had the market swoon, Universal Display got all the way down to $80. Here it is at 167. That was only 3 months ago. So you either trade it or you have an active manager like us actually handle it. But it's certainly not a buy and hold.
We have Caroline calling from Burnaby, BC. I'm sorry, we just heard from Caroline. Jerry in Toronto. Jerry, go ahead, please.
Good afternoon, Kim and Andy.
Hi there.
My question today is about Activision Blizzard, ATVI. I've actually had it for quite a long time. I actually bought it around 11.50, 11.75, and so I've had it a long time. But I saw it go way up to like the 70s or 80s and came down in that market downturn a few months ago, but it hasn't really recovered. It's in the 40s. What do you think? Do you think I should be selling this, buying more, selling partial? What do you think? Or what's your opinion of Activision Blizzard? And Andy, if you could give us consensus, I'd appreciate it. Thanks very much.
For sure. The big games company, Activision.
Yeah. So in this space of gaming, there are primarily three players. There's Activision, there's Electronic Arts, and Take-Two. And there are other players around that, but those are the leadership. There was a lot of hype going in to last fall, the end of the year, and then it got caught in the market swoon, and it traded all the way down, to where is that? Yeah, you're right. It really sort of hasn't recovered. Activision Blizzard just did something with their what is it? The Legends game. They actually allow people to play it for free. You don't have to buy it.
But is there in-game purchases?
Yes, exactly.
You buy special helmets or swords or whatever you buy. Yeah.
So I would hold. I wouldn't sell. But I wouldn't add to it. I'd wait for the market to sort of digest the hype that happened in the latter part of last year.
Okay, and sorry, Kim, you may have touched on this. Why are the shares down over the past while?
Well, it was primarily because of all the hype.
Sure.
And I was on last fall, and we were talking about the gaming side, and it was a big trend that everyone was trying to chase. It was like a Bitcoin chase, and everything just got bid up. And the results that came out at the beginning of February just didn't warrant for more buyers to come back in.
And also, I suppose Fortnite has been stealing the lunch of quite a few video game makers, or at least that's the market's perception, anyway.
Yeah, but that's true on one hand, but on the other hand, it brought a lot of new players into it, right?
Yeah.
And so, and on top of that, there's been some headwinds, particularly over in the Asian market, where in China, the Chinese government actually put a moratorium on Tencent.
Oh, yeah.
And that happened in the latter part of last year. They've taken the moratorium away. They've cleaned things up a little bit. So I would just wait for the market to sort of digest what it is right now.
Let's head to Calgary. Ram is on the line. Go ahead, Ram.
Could I ask about Alibaba? Like, it's a Chinese company, and what is your opinion about that? Because it has now PEG ratio of around 1 or so, and it's diversified, like its revenues are from Southeast Asia too, quite a bit. Please give your thoughts on this stock. Thanks.
Alibaba.
Oh, Alibaba. Where do I start? Alibaba, there's really sort of the fangs of China, and Alibaba is one of them. This is a buy and hold, and I would stick with it. I will, and you're right. We have a price target on this of 202.75. The reporting, they have a big e-commerce side to their business, big advertising spend within it. And so trading right here at 180, and we have a 12-month target of 202.75, I would recommend it as a buy here.
Okay, so you'd be interested in Alibaba
Yep,
at this
and
stage.
we own it.
Stay tuned. Past picks are coming up next. Kim was on our show at the end of August. Workday was his first top pick at 27% return. What do they do again?
Workday is one of those software as a service companies. And the particular field that they service in is within human resources and also into financial reporting for enterprise, for firms around the world. They've become quite a darling. You know, them together with Salesforce really jumped on the whole idea of, instead of licensing but going to subscriptions, which gives you consistent recurring revenue, and they have an awesome product. I'll tell you the reason that I actually bought it, because we, just as a side, we were at a conference and we sat down with the management of Microsoft, and they actually mentioned that they use Workday software as a service. And that actually a couple of years ago, that would be 2 summers ago, that we started to buy into it. So anyway, Workday, we sold it. Here it is at 194. We sold it, we took profit at 193 back in February. When you can see it, it just sort of jumped there. It reported on February 28th. Everything was great, top line, bottom line. Looking ahead, total billings, growth of about 34%. We have a price target of 202. That's why we took profit here. It is expensive. It's got a peg of about 3.66. We'd look to actually buy back in sort of the 170s area.
Okay. Alphabet, this one losing a bit of altitude over the period.
Yeah. This is a core holding of ours, and we actually don't trade around it very much. It's one of the best positions companies out there for the secular trends of digital advertising. But then on top of that, it has a lot of non-advertising revenue streams with Google Cloud and hardware and Google Play and subscriptions and so on. Our price target on this is $13.50, and it's not that expensive. It's got a PEG ratio of 1.6.
Oh, okay. So you would stick with this? Is, I mean,
it's core.
Yeah, it's such an empire that central to the internet.
Exactly, and it has, it's sort of like the Amazon of Amazon and the e-commerce, and then Google on the digital advertising side. So they're cores.
Would they ever try to break it up?
Would they? No, because that digital advertising funds all that other stuff.
No, I mean the government regulators.
Oh,
Washington, for example, would they ever try to?
They'd love to. Well, the Democrats would. The Republicans, I don't think, would ever do that.
Right. Fanuc, the player in robotics, a loss of 4%.
Yeah. This is a smaller position, but we really like both Fanuc and Yaskawa Electric because they're leaders within that sort of whole machine automation and robotics. It's a very strategic play. It has some cyclicality above it. They didn't warn, they just sort of brought down their full year profits guidance just a little bit. But I think it's a great place to actually buy it. And we've got a price target here of $24, and it's sitting at around 18.5.
So you would stick with it for now? Stick
with it and recommend it as a buy.
Right. And is it a play just on the economy generally in that manufacturers use the equipment?
No. It's when you walk into any manufacturing facility, anything, you're going to find their equipment on either machine automation or in the robotics. The robotics is huge, for example, within the automobile industry. But that's where their customers are cyclical, right? Which causes them to be cyclical.
We will take a break. Kim Bolton is our guest, president and portfolio manager at Black Swan Dexteritas. He's answering your questions on technology stocks. Give him a call, 1-855-326-6266. We are back. We're talking tech stocks with Kim Bolton. Chris is standing by in Hamilton, Ontario. Go ahead, Chris.
Good afternoon. Thank you for taking my call.
Pleasure.
I'd like Kim's view on Apple now that it's declared itself a service company. Do you own it? Would you continue to buy it? And would you buy it at where it is now, or would you wait for a bit of a pullback? Thanks very much.
Thanks very much, Chris. Yes, we own it. Would we buy it here? It's sitting, I think, right around, what, 194, 195.
Let's have a look.
On the U.S.
Okay.
Yeah, 190, almost 196 on today. You know, we owned it. We shed a little bit on the quarter one earnings. And then once we saw it actually bottom down there, you know, sort of in the 160s, 170s, we actually added it back, and we have about a 4.5% position. We just believe that the analysts have extrapolated too far on the weak Q1 quarter and extrapolated it into the future. And it's interesting, Chris, that you mentioned about the services, because we think that that's where the opportunity is for the gross margins to march much higher as a result of those new services. With the Apple TV, you know, the first day that they came out, no, it was with the Apple News. First day that they came out with Apple News last week, they had 250,000 subscribers that day. So they have Apple TV, they have Apple TV channels, the Apple News, they have Apple Card and the Apple Arcade, and these are all the new services that they're bringing out that have much higher margins. And then you add on top of that the wearables and the AirPod 2 that has come out that is very popular. Now, it's come off about $40 off its highs, even at this stage. But, you know, at 196, it still only trades at an enterprise value of about 12 times current fiscal 2020 estimates. And we just believe that services side is going to be a great addition to their stock.
What about this story that UBS, a UBS analyst thinks that they won't have a 5G phone. Even next year, won't have a 5G iPhone. Will that be a setback?
I don't think so. You know, when you look at the hardware that Apple brings out, they're never a leader.
No, they're never cutting edge, apparently. Yeah.
And
except the iPhone itself. The original iPhone itself was.
Right. But you think about why that is. It's not as though they're not innovative, but Apple has such a broad footprint. And when they come out with a product and even a service, they have to scale it to an immense audience. And I think that's why they don't come out as a leader. And they let other people come out, and then they come in, and then they have such a brand and an audience out there, they don't have to be a leader.
Right, yeah. Does that lead to mediocrity? You get these big incumbents with a massive base that are sticky, so that it means that you won't get as much innovation occurring anymore.
Well, if you call innovation being first to market, I'd agree with you.
But
But innovation, when it comes to what they're working in the back room, I think they're very, very progressive.
Yeah, and of course, yeah, the interesting thing is, I suppose, do people really need 5G phones in the near term anyway? Because the services will take a while to roll out.
Well, you know, to us, the 5G is not just an evolution of the digital world. This is going to be a massive revolution because it is going to make everything real time. Everything is going to be real time. Instead of you come in, you cycle in, I take the subway in. It drives me crazy that you can't get your internet in the subway. But with the 5G deployment, you're going to be able to get internet with no latency right now, whenever you want it.
That'll be a change, all right. Yeah.
It will be massive. And it will be massive for the consumers, but it will be massive when it comes for the Internet of Things, the Internet of everything. Because now the whole machine world will be real time. So that's why we think it's a revolution.
Okay, well, hopefully we'll have more time to talk about that later in the show. Joe in Winnipeg, go ahead, please.
Andy, I'd like to get Ken's opinion on Horizon ETF called RBOT. I'll hang up and I'll listen to you.
Okay, thank you very much. I'm sorry, what was his name?
I think that was Joe in Winnipeg,
Joe.
and he wants to know about RBOT, the robotics ETF.
Thanks very much, Joe. We sort of flip back and forth between the RBOT and the BOTZ. Just to step back, the reason we started to, our portfolio is now made up of half of it is ETFs and half of it is single stocks. Very different from what we've done over the last 5 or 6 years, where it was we had a stable, we had a portfolio of around 30 to 40 single stocks in the portfolio across a number of strategic trends, and so last year what we learned is that last year you had 6 corrections of less than 10% and 2 corrections in excess of 10%. So we learned going into the fourth quarter of last year that we had to be more agile, flexible, and so that's why we actually cut the stable of single stocks in half. So we've got about 16, 18 single stocks, and then the other half is in ETFs. Now, to go back to you, Joe, about 10% of the portfolio is dedicated into robotics and machine automation, because we believe that to be a strategic trend that has a long, long runway. And so we sort of pair it up between the RBOT and the BOTZ. And we're just sort of experimenting which one we like best right now.
Let us head to Vancouver. Doug, you're on the air. I'm not hearing Doug. BlackBerry was the question.
Okay. We don't own it. We have owned it, but we haven't owned it since early last year. We bought it this is on the U.S. dollar side. We bought it with about an 8 handle. We let it go just shy of $11. And then we follow it very, very closely. Very much liked what they did with that purchase of, what was it, the AI Xilinx, of the AI company that they bought. Now, they popped on the earnings, what was it, last Friday. But when you dig through it, it was, to us, it sort of told us that it was a one-time event. That their top and bottom line and whether they'd actually be able to continue. So we're following it.
Okay, but not wooing you right now to be a buyer.
Right.
Kim Bolton is our guest today. We'll be right back. And he's taking your questions on technology stocks. 1-855-326-6266. We have Nicole calling from Toronto. Go ahead, Nicole.
Kim, I've had Oracle for a long time, and I know it's been going up very slowly, but I would like your opinion on whether I should hold it or if I should sell it, or what your views are. Thank you.
Mm-hmm. Thanks, Nicole. We follow Oracle, but we don't own it. We just see better opportunities. Whether it's fair or not, we sort of categorize Oracle in the same space as an IBM, mainly because they carry with them sort of a ball and chain of a lot of legacy product. And they aren't very innovative, but they have a lot of legacy product. And it depends, Nicole, what interests you in Oracle. If you're interested in the hardware space or within the cloud space, I think there are better opportunities.
Oh,
that's
okay.
my opinion.
You're not sold on Oracle right now. Kathy in Belleville, Ontario. Go ahead, Kathy.
Yes, thank you for taking my call. Could I please have your guest opinion on OpenText? It's pretty close to its high. Would you be buying it at this point, or would you be waiting for a pullback? Or do you think I'd be better off buying a stock like Kinaxis? It's really been going high quite a bit. If you can answer that for me, I'd really appreciate it. Thank you.
Okay, OpenText it is.
Thanks, Dennis. We don't. Wish it did, but we don't own OpenText. Follow it very, very closely. OpenText develops and sells this software of enterprise information management, and it just helps enterprise companies out there to digitalize processes and supply chains. Mm-hmm. And they're extremely good at it, and they have clients all over the world. It's a fabulous Canadian story. It's well diversified, has that recurring revenues, which we like, and it's not just us. There's this research firm called Gartner. Gartner Research, which is one of the largest technology research, independent research firms around the world, and they have it as one of their leadership quadrant companies in content services platform distribution. OpenText, they maintain a double-digit recurring growth, but we just see it as expensive. As I said, Dennis, I wish I would have bought it, but we have it on the list to buy it down in sort of the mid-30s. Here it is up in just over 150, just over 51.
Dennis in Brampton, Ontario, has sent us an email. Wants to know about Lyft. Would you be an investor? The stock, of course, first sold at $72, now trading around $71.
Yeah. And, it came out last Friday, right? Came out at 72, actually shot up into the low 80s. Mm-hmm. And earlier this week, actually got down to, I think it was around 69. We're still we don't own it. But based on the sales multiples, the valuation actually looks reasonable, given its pace of growth. But the biggest problem for them, and it's a number of big companies, these unicorns and these billion-dollar companies, and they may have revenues of billions of dollars, but they also have losses of billions of dollars. And so we're skeptical. We're a hedge fund. I'm not skeptical enough to actually short it. But we're watching how the whole story unfolds.
Well, Bloomberg reporting that it's an extremely expensive stock to short right now.
Guggenheim out of New York actually came out yesterday, and they have a price target of $42.
Wow.
Yeah. So, a lot of the analysts, a lot of the portfolio managers are just trying to get their head around it. I don't know what, is this going to be another Snap or another Facebook? We were talking about Facebook earlier. When Facebook came out, it came out at $38. Within 6 months, it was all the way down to 19.
Wow, so it lost half its value, Facebook, initially?
Yeah. And I actually bought it at $38.25, but we bought it on the way down, too. And then it proceeded to go all the way up to, $250, and then pulled back to $155. So Lyft is worth following and see how the story unfolds.
Apparently, Wedbush is quoted by Bloomberg as saying, Dan Ives, a managing director over there, says apparently that there's a better chance of landing a person on Mars than Lyft turning a profit. I don't think we're landing a person on Mars anytime soon anyway. Okay, where time goes so quickly. Top picks coming from Kim Bolton next. Okay, we are back. Let's get to those top picks. Number one, Splunk. What do they do?
Splunk is a big player in that big data space. Okay, for you and I, Andrew, Splunk, Tableau, software as a service, the origins of it goes back to the Excel spreadsheet. And they were the ones that took the Excel spreadsheet and they put it onto a dashboard for you and I to actually look and maneuver data. And so now they have their data play within clouds. And it's just, they've just got on the right trends at the right time with big data, putting it over in the cloud. But then they had a side business that has now become a more mature business in a cybersecurity offering. So they got them all covered, from the cloud to the data to the cybersecurity. Q4 earnings and billings metrics were well above consensus. However, they did actually lower the guidance, which gave everyone an opportunity to actually buy in back in January, because we were coming out of that swoon and everyone was uncertain about what was going on. And so we actually have a price target of $137 on this, and it's not that expensive. It's got a PEG ratio of 2.07.
Oh, okay. So it's earnings, its PE ratio is about 3 times its gross, which is not too bad for this kind of a name. Okay. Exactly. You've got Infineon, another chip maker.
Correct. So they're on the on digital chips, and they very much are a leader in the supplier of chips to the automotive ecosystem and the electric vehicles, but they also offer chips in power management, both to the autonomous driving and electric vehicles out there. But their customers are cyclical. That is an issue. And the other sort of headwind that they had is they're a Dutch-German company. And so, as you know, Andrew, Europe, the macro picture of Europe has not been all that bright. As a result of that, they actually lowered the guidance in March 28th. It gave us an opportunity to actually sell a little bit and then buy it back. We have a price target on this of $34, which is a heck of a lot higher than where it is right now. I think it's trading right around 20-ish. And the PEG ratio is cheap. It's 1.6.
And finally, Arista Networks. What do they do again, Kim, please?
Arista, gosh, it's been around for probably 5 or 6 years. It was some management teams out of Cisco that went out and they started up their own sort of switching and networking company. But they, Cisco is one of those companies that sort of had some legacy products. They started up the company. They could be very progressive, and so they got into the whole data center switching. They knew a lot of the clients, and so they have tremendous revenue going forward. And you can see it in the numbers. They're delivering 23% or better on revenue growth. And we see that extending over into 2020 and 2021. And we got a price target on this of $360.
Okay, Kim, we'll have to leave it there. Always fun. Thank you very much
Thanks,
indeed.
Andy.
Kim Bolton has been our guest on Market Call. Thanks very much indeed for watching. We love getting your questions. Email us anytime, day or night, marketcall@bnnbloomberg.ca, and we'll be back tomorrow.